Hello and welcome back to the Algotistical Podcast episode 48. I do wish everybody a happy and healthy start to the day. And we're going to jump straight into this, okay? So how to trade. I think we're going to simplify this in the best way I can today. Simply segment all the analysis in a nice fashion so you can follow along and take notes perhaps and be influenced. Great time to say I'm not a financial advisor. None of this should be deemed as financial advice. I'm simply sharing my journal with you of what I've experienced over the last 8 years with exposure into this market. So it's incredibly volatile. What we're here to do is navigate the 7 C's of liquidity by governing momentum, which is the tide, which way it's going. You don't want to be the bloke that goes against the tide and dies. And equally, you want to go with the tide and set your sail accordingly so you go upstream or downstream, mote it be. So we're going to be discussing some of these nuanced topics like momentum, the inflections on it based on decimals. Then we're going to be looking at volume. We're going to be looking at the trend, looking at resistance and support. So sort of, draw a thesis on this. We'll be using multiple postulates like, technical analysis, fundamental analysis, and that should paint the picture. So let's jump into it. Always observations over opinions. That's what we're here to do. And let's crack on with just that. So let's draw your attention to the monthly time fractal. What we can see on the monthly, most importantly, is 72% sell pressure with 23 days and 14 hours until expiry. So what that tells us is that the sellers are more dominant this month. Bearing in mind, we're only 7 days into November with 3 weeks to go. But at the moment, the bears are in control, meaning the sell pressure is dominant. And I don't go against dominance, okay? We identify dominance and we adapt, okay? This is what we're here to do. We adapt to the data. That's like meteorology. When the data changes, the synopsis should change. You don't want to get married to an asset class. You don't want to get married to a market, because when the data changes, you might want to update your relationship status. Does that make sense? Okay, let's go into it then. So the volume will be dancing over the next 23 days and 14 hours. Notably, right now it's crept up to a 70% sell pressure dominance. So just keep your fingers on the pulse there. That's why we use our trend volume pro version 3 indicator to actually tell us the quantitative number, so it's not subjective opinion or feelings. Okay, it's always formula over feelings. And that's very strictly baked into the algorithm. So let's discuss this then. So that's the first thing. The second thing I want to bring to your attention is the historical norm, which is this red line that you see right here. Now this is creeping down as the weeks have been progressing, but at the moment, as long as we're underneath 37,000, like we've discussed in multiple episodes of this podcast, as long as the monthly is underneath 37,000, risk is to the downside, okay? Right now, Bitcoin is worth $34,639. So we are underneath that inflection by approximately $2,000, give or take some change either side. But the idea is very simple. As long as we're under resistance, price action will float in the area of least resistance, so it'll be propelled away. Like in science, back in the day in school, and we had 2 magnets, right? And we'd put those magnets together, but the opposite sides, and the magnets would repel. You couldn't see the force in the middle, but you'd feel it with your hands, right? It repels. That's price action and resistance. They might go close together, but they won't gel, okay? They will try and repel. So just keep that in your mind. Now, that's what it's doing right now, right? It tried to gel, but it's repelling. Now, an extension to this thesis would be this. We see a white horizontal line predicate on the trend volume pro version 3 indicator, which tells us that this is another added area of confluence to call it resistance. Not just an opinion that I've just plucked out my arse because it sounds cool, on topic or on trend. This is something I measure with a BDI every single day on this podcast. So again, as long as we're underneath A, the white line, bad, B, the red line, extra bad, and C, the volume is extra bad. So, A, B, and C, we can kind of draw the thesis there. Now, an extension, I suppose D, would be the RSI, right? So the RSI is falling as long as Bitcoin's failing to reclaim back above $34,660. So, in essence, we are $60 underneath that inflection right now. Bitcoin is now clinching onto 34.6. But remember, as long as it's under 34,660, momentum is now curling to the downside on a monthly. So that's kind of big for me, right? That's kind of big for me. I don't go against the relative strength index. The relative strength index was founded by a guy called J. Wells Wilder almost a century ago, right? Almost 100 years ago. So this data predates me. I've been knocking around the earth for 30 years. This is more than triple my age. I don't go against that shit. Okay, leave it there. So yeah, that's the monthly kind of boxed off. Let's go into the weekly. How are we doing for time? 5 minutes, not too bad, cool. So weekly, how are we looking? So weekly, we've got 97% sell pressure with 5 days and 14 hours until the weekly expires. We see similar etchings on the signature of volume, meaning we've got 97% sell pressure this week, which is very bad, of course. We've also got this white horizontal line holding us as resistance, which is exactly as we saw in the monthly. And what we can see here as well is the RSI is dissipating to the downside. The inflection on this is slightly less than the monthly, only by $10, okay? So that means that the RSI on a weekly level will continue falling underneath $35,051, okay? That's the all-important magical number. Risk remains to the downside as long as price action's below it. However, if we go back above it, then that would be, you know, very indicative of further continuation back to the upside. But again, we're not here to do hypothetical abstractions. We're here to measure the truth and measure the reality and what we see, not what could be, okay? So again, we're underneath 35. That is bad, simple as that. So cool, I think that's cool. Is there anything else to mention on this? We see volatility expanding on this move, so it does mean that this move does have credence. And I think that's about all I want to mention on the weekly. So is there anything else? Yeah, so let's discuss this really quickly on the weekly, actually. So if we cast our minds back to last week Thursday, that was the new current yearly high for Bitcoin. So the new current yearly high for Bitcoin was last Thursday, which was, I do believe, the 2nd of November, right? So the 2nd of November was the all-time high this year. The all-time high ever was back in November 2021, back at 69 Gs. So respectfully, we're now 34.6. That does mean we're still 50% away from our all-time high ever on Bitcoin. So the North remembers, technically speaking, we've been falling for a few years now. Just because we've gone up since November last year, November 2022 till now, does not mean we're in a macro uptrend. It means we've had a correction to the upside, but the general trend over the last 2 years has been biblically down, and we're still a far cry from where we used to be. Okay, so just referencing it properly. The total cryptocurrency market cap used to be $3 trillion of fiscal energy. Right now, the total cryptocurrency market cap is a merely $1.28 trillion. So it does mean over the last 2 year period we've dropped about $2 trillion with a T dollars, which is biblical. Okay, imagine liquidity running for the exit. There's a fire alarm at school or in your office building and no one knows it's a drill, so they're treating it like the real thing and they're rushing to the fire exit. That's what's happened over the last 2 years in cryptocurrency, if we're to summarize the dissipation of fiscal energy. Okay, something doesn't just go from 3 trillion all the way down to 1.28 trillion for shits and giggles. That means 2 trillion has left the market for a reason. Okay, cool, leave it there. Let's pull up a daily then, real quick. So looking at the daily, what do we see? Again, we see exactly the same signature on a monthly and a weekly, just a little bit more detail on a daily. This is what you see with multiple time fractal analysis. Time is fractal in nature, so it's always going to be the same but slightly different, right? Slightly standard deviations to it. Does that make sense? Cool, let's make it make sense. So looking at the daily, what do we see? We've got 95% sell pressure with 13 hours and 4 minutes until today expires. What we can also see is that price action is above all of its moving averages, however. So this is something that is good for the bulls, okay? So we do see price action above the 21-day look back period, above the 55-day look back period, and above the 200-day look back period. So yeah, you know, we can drop and that'll be perfectly fine, and these levels of averages would be deemed as branches on the tree. Okay, so imagine you've got a tree house, you're playing on the tree, but accidentally, you know, your foot slips and you're going to hit a few branches on the way down. Now that's what price action is going to do, proverbially, right? Price action will hit a few branches, which is the 21-day look back period, number 1, number 2, the 55, number 3, the 200-day, okay? So that's how you got to be sort of formalizing this. We might catch a bid on one of those branches, might find support, see how it acts, or we could just shatter and fall straight through all these branches. That is a certain plausibility, okay? Certainly not at the realm of reason in the Rulliad, right? In the Rulliad, anything's possible. And as Bayesian statisticians, as technical analysis nerds, we have to be aware of that random law of chaos. Anything can happen in the Rulliad. Okay, leave it there. A lot of you don't understand about the ether, but that is basically the ether. I think Stephen Wolfram coined it the best. He's got a new TED Talk, so if you want to do some homework on the Rulliad and this way of thinking, again, Stephen Wolfram TED Talks, it's really, really good. Check it out. But anyways, leave it there. What else is there to discuss on a daily time fractal? I don't think there's anything else that I want to mention. Of course, hold on 1 second. 1 second, sir. Let's bring your attention to the inflection indicator, our trend volume inflection metric. So what we can see here is confluence across momentum, which is aggressively waning to the downside. So notably, I'm going to give you some real hard, tangible numbers to really anchor your thesis on. And it goes something like this. The relative strength index will continue falling as long as Bitcoin is failing to reclaim back above $35,045. The moving average convergence divergence, better known as MACD, will continue falling as long as Bitcoin is failing, which it is, to go back above $35,926. And then we look at the stochastic reflexivity, which is picking up velocity to the downside biblically, as long as Bitcoin is failing, which it is, to go back above $35,709. So let's push that jargon to the side, keep it very simple with you. What we do here is look at the largest number and smallest number, meaning the numerator and the denominator. And in this circumstance, that would be 35 flat, let's say, and 35.9, let's say. So realistically, as long as we're underneath 35, no hope. If we go above 35, there is hope back up to 35.9, then it's back to the downside. Okay, those are the levels of contention. And that's how I'd be managing my risk realistically, level by level. Okay? So again, what's in motion tends to stay in motion till it stops. This is one of the laws of physics, and I believe we live in a computational universe. Everything can be quantified in terms of electric, atoms, and physics, and, you know, all that jazz. So I do put a lot of weight on geometry, time analysis, volume analysis, because it anchors us to this realm of reality. It really does. So let's talk about this then. What we also see on this inflection metric is volatility in the critical territory. We also see stochastics and RSI in the critical territory. So what happens from here then? If something's in the critical territory, what does this mean? So in terms of momentum, it's above an 80 read, okay? So we're looking at stochastics above an 80 read and RSI above an 80 read. And we see volatility underneath a 20 read, okay? So what does that mean? Underneath a 20 read is critical. Above a 80 read is critical. It's measured out of 100, okay? So what we'd expect is a massive move to occur. We'd expect to get kicked out the critical zone, and we'd expect a big move to transpire as a repercussion of that. Now, we see the stochastics contracting. They're at an 82 read, approximately 82 at current time of recording this. So I do suspect that the stochastics will not cool off until it goes back down to 20, right? So that means we've got about a 60 drop to go. And same thing with RSI, right? RSI is approximately a 92 read. Massively overextended, massively overbought, and the market would like to cool down. Imagine a hot coil, right? It's a hot coil, it'd like to cool off. Does that make sense? Or just imagine you're driving a car at massive speed down the motorway or dual carriageway, and the gauge is right to the right, and then you take your foot off the accelerator, and then it starts to go back to its default, which is back down to the left. Okay, and that's exactly what you'd expect with this momentum oscillator. You know, it would go red raw hot, then it would like to cool off, and that's perfectly cool. We call that thermodynamics in the real world. And the markets are exactly the same. They follow the laws of thermodynamics. So, in summary, what we're going to be discussing now is the 4-hour time fractal. So if we look at the 4-hour time fractal, and I'm going to end it here. This is 40 minutes, doing really well for timing thus far, which is really good. So if we're looking at the 4-hour time fractal, we can see that price action is underneath its 21-day look-back period and 55-day look-back period. What we can also see is that there's 84% sell pressure engulfing the market with 58 minutes until this 4-hour candlestick expires. Very important stuff, okay? Now, what we can also see is momentum all in tandem here. So we see stochastics nosediving, RSI nosediving, and volatility expanding at the critical territory. So that tells me this move does certainly have legs. We are by no means at a bottom here, and we're at no means at a region where, you know, one should be buying or speculating to the upside. I believe that these momentum oscillators still need to unravel and cool off until they can continue back to the upside. Cool. Now, is there anything else worth mentioning on topic? I don't think so. I think we've blitzed through the alpha there. If we just go back to the monthly and bring it to a landing here, that's to say this, guys and dolls. As long as we're underneath 35, risk is certainly to the downside, and especially underneath 37. As always, we've been harping on about that magical number for a very, very long time, for many, many weeks. Now, what I want you to bring your attention to is the... One second, guys. Apologies. So what I want you to bring your attention to is the fundamental analysis last and foremost. We've discussed the technical analysis, which is super important to understand when we're narrating data-driven decisions and making, you know, data visualizations. Very important stuff. But what we must do, okay, let me zoom in here so you guys can actually see what we're talking. What we must do is understand the environment, because environment is stronger than our willpower. So what does that mean? Realistically, this week, tomorrow, we've got the Bank of England and we've got the Federal Reserve coming out with monetary policy. So that means Andrew Bailey and Jerome Powell will be discussing new monetary policy and the implications it has. That will have a direct correlation with risk on markets, meaning Veblen goods driven on supply and demand dynamics. It will have a direct correlation. None of this is by chance or by gambling, right? It's designed this way by the people that understand it, okay? And that would be the Bank of England and the Federal Reserve, who control the M2 money supply. Now, an extension would be on Thursday, we've got the Chinese CPI coming out, which is the Consumer Price Index year on year. That tells us the productivity of the Asian markets. So is Asia being productive or are they not? That is very indicative of growth across the Atlas. Again, it does have a direct implication for risk on assets driven on supply and demand dynamics, better known as Veblen goods. Now, on Friday, we do have the UK GDP, which is the gross domestic product value, which comes out month on month, and that will be on the Friday, okay? So, again, what does this all mean? It means that this week will be volatile, particularly tomorrow, Thursday, and Friday, okay? Tomorrow, Thursday, and Friday is what you should be focused on. And whatever these figureheads say, it will have a direct impact on, you know, stocks and shares, precious metals, the property market, your food at your local shop, and everything else in the middle, okay? So you have to be cognizant of these real things that matter, not the fake news, okay? The real news, the news that is driven on numerical truth. What we can measure gets accomplished in every endeavor. So I'll leave it there. I think that's a great place to leave it, guys and dolls. Yeah, just be safe. You know, each one teach one. Socrates once said, one thing I do know is I do not know everything. So seek and you shall find. And I'm going to leave it there. Thanks for attending this podcast. It's been algotistical as always. I'll see you on the next one. God bless.